May 2023, the IFC has established a leading position in promoting the private sector in Africa. Over nearly 6 decades, the IFC has invested more than 25 billion in African businesses and financial institutions, and our current portfolio exceeds 5 billion. We're a leading provider of advice to promote sustainable private sector and to mobilize capital from other investors who invest alongside IFC in critical sectors for Africa's future. In less than a year, the African Development Bank will be celebrating their 40th anniversary. This comes at a time when there is growing consensus over the continent on the need for Africa to have ownership of its own development. In tune with this, Africa heads of state in 2003 committed their leadership to a new economic partnership for Africa's development, which centers on African ownership and management agenda strategy, the process of the continent's development. In fact, the overarching goal is for Africa to claim this millennium. The AFDB is tasked with coordinating and facilitating the NEPAD. African Development Bank is widely regarded as the premier financial and development institution in Africa. The bank started its operations in 1966 with a clear mandate to promote the economic and social development of its regional members, to promote international dialogue and understanding of development issues relevant to Africa. Within its general policies, the development indicated the intention to provide energy services to the maximum number of households, at least the least economic environment cost. This was done through loans, equity investment, technical assistance to regional member countries. This envisaged regional leadership has remained pipe dream. However, institutions of the global economic governance like the World Bank and the National Monetary Fund provided external influences on bank operations. It is important to assess how far the bank has lived up to its commitment to this position. Africa's infrastructure on the path to sustainable development. A look at AFDB Energy portfolio provides answers to these questions, whilst basic indicators of transparency between the FD and the World Bank are also looking at it. Questions: what do you understand by the special drawings rights, and discuss the significance in the international finance and situations where it can assist Zambia? But B, how can inflation rates and foreign exchange rates, how are they related? And illustrate with the help of an example in the context of the Zambian economy. How would you advise Zambia to manage its currency risk? Right. Okay, so the first question is asking us to explain what we understand by the SDRs and its significance to international finance and situations where it can assist. Okay, so the understanding of the said SDR, SDRS, and also we're going to outline the significance. Okay, so by definition, this is an international reserve asset that is usually created by the IMF to supplement its member countries' official reserves. So this SD has the following features and significance. Okay, so here we are. So the SDR has a mandate. It is an organ that is its special drawings right is an international reserve asset that is established by the IMF. It was established in 1969. Its main mandate was to supplement what? Official foreign reserves to its member countries. So SDRs are not currency in themselves, but rather they have a potential to claim, or they have a potential claim on the freely usable currencies of the IMF members. So their value is determined basically on the basket of the five major currencies: the US dollar, the euro, the Chinese, the Japanese yen, and the British sterling. So what is the significance of the SDR? Number one, for global enhancement, global liquidity enhancement. Number two, it is used in IMF transactions and can be exchanged for freely usable currencies. Number three, it is used in allocation. It improves the country's balance of payment. So what we mean by global liquidity enhancement, it means they play a role in boosting the global liquidity because they provide countries with access to foreign exchange without the need to borrow at the market rate. So this will help them to stabilize international financial systems. And they also help in supplementing foreign exchange reserves, meaning when you hold SDRs, countries are able to supplement their foreign reserves and can help ease the pressure that is embedded on the balance of payments and supporting national currencies. It helps in facilitating IMF transactions because the SDRs are actually used as a unit of account by IMF and can be exchanged among these member countries for usable currencies, as mentioned, like the US dollar, the euros. So it enables countries to meet their international obligations more easily. By supporting economic stability, the use of SDRs helps to contribute to macro stability by helping these countries manage their debt. Now, how is application to Zambia? How can we apply this to Zambia? So, number one, it can support currency stabilization and it can reduce the reliance on expensive debt for our country. So, in terms of currency stabilization, our country, among others, that face frequent exchange rate pressures. So these SDR allocations can provide a buffer that supports the Zambian kwacha. So they help us to maintain currency stability and reduce inflationary pressures. Secondly, they're useful during economic crisis like COVID for budget support, right? So we had benefited from these SDR allocations ourselves um, because it was used to support the health systems and also sustain critical government services. How else are these SDRs useful? They're useful in budgetary balance of payments and in reduction on the reliance on expensive debt instruments. So when we're using SDRs, we can avoid turning them into high interest international loans. So they often worsen long-term debt stability. So this is how significant they are. Question number, um, so these are the importances, okay? They help in budgetary balance of payments, meaning they offer Zambia a low cost means of financing. So the country can use these SDRs to uh, boost its balance of payments and also to meet the external obligations and finance the vital inputs like fuel, medicine, food without worsening its debt burden. Also, they help in reducing the reliance on expensive debt instruments. So when you're utilizing SDRs, Zambia can avoid turning into high interest international loans. Okay, so now let's look at the second part of the question. It's asking us to explain how inflation rates and foreign um, um, how inflation rates and foreign exchange rates are related. Okay, can anyone try? How are these two related? Okay, actually in the interest of time, um, the relationship between exchange rate and inflation rate can be summarized as follows in terms of purchasing power, in terms of interest rates and currency depreciation, and also in terms of investor confidence. So they're related in many ways. So currencies with high inflation rate um, known to lose their relative currencies with lower inflation. So we can relate them in these variables. Number one, using purchasing power parity. So currencies with low inflation rates lose value relative to their currencies with a lower inflation. Number two, in terms of interest rate differentials, the central bank raise interest rates to control inflation, which can attract foreign capital and strengthen the currency temporarily. In terms of currency depreciation, high inflation erodes currency value, which will lead to depreciation of what? Foreign exchange market. So when the inflation rate is high, the foreign exchange market becomes depreciated. The other relationship is that when the inflation increases in domestic prices to reduce exports, which will increase imports and thereby weaken the exchange rate. In terms of investor confidence, when the inflation rate is high, it reduces investor confidence, which will lead to capital outflows and depreciating the domestic currency. So these are relationships that we can look at in different angles. So the relationship between these two basically can be looked at in many ways. So ultimately, we can also mainly talk about the purchasing power parity. Okay, that interest rate parity will suggest that higher inflation will lead to depreciation of the local currency. Now, how can we apply this to our Zambian setup? So in relation to our Zambian setup, we can simply say that Zambia experienced quite a depreciation during the COVID-19 as inflation went up due to the supply chain disruptions. So SMEs faced higher import costs, also increasing their operational expenses, which caused a reduction in productivity and disclosures. So meaning the exchange rate moved from 14 to 20 US dollar at its peak during the pandemic. So we can see the impact that inflation had on the exchange rate. So high interest rate will weaken the exchange rate. Okay. Then part C, what advice do you have for Zambia in managing what? Currency risk. How is currency risk managed? Hey, Max, how do you think currency risk can be managed? So to manage currency risk, Zambia should adopt a multi um, pronged approach, which combines a number of economic strategies. Okay, so here are some of the listed ways in which the country can manage currency risk. What is currency risk, by the way? What do you understand by currency risk? So when we're talking about currency risk, we are basically looking at exchange rate risk, which refers to the potential um, financial loss that will arise from fluctuations in the exchange rate between two countries. So this is exchange rate risk. It is relevant for businesses, for investors, for governments, or international bodies to understand this. There are many types of currency risk. There's what we call transaction, translation, and economic risk under these currency risk. Okay, so before I answer the question on how to combat this, I think you would be better positioned to understand what types of currency risks we have. Okay, so currency risk is also known as what? Exchange risk. It is a potential to the financial loss that arises from fluctuations in the exchange rates between two currencies. So the types of currency risk, we have transaction risk, which occurs when a company has outstanding financial obligations like imports, exports in a foreign currency. So if the exchange rate moves unfavorably before the transaction is settled, the company may lose money. So this happens when you want to pay your debt, but the currency exchange rate changes, so you pay more than you're supposed to. All right. So what other type of currency risk do we have? We have a translation risk, which um, attracts or affects multinational companies that need to convert their financial results in a foreign subsidiary into their home currency. So for consolidated statements, so unfavorable exchange rates movements will reduce their reported earnings. So for instance, you have 20 million, okay, in US dollars. If a currency has to be translated in Zambian kwacha may be weakened. There's also an economic risk, which is part of currency risk. It refers to a long-term effect of exchange rate changes on a company's market value and future cash flow. So it can impact competitive position and decision making. So now we'll go back to our question. Our question is asking us, what advice would you give? What advice would you give Zambia in managing this currency risk? How can this currency risk be managed? So it can be managed in many ways. Number one, in diversifying. Number two, in improving fiscal discipline as a country. Number three, we can look at adopting transparent, credible monetary policy. So let's look at these ones in depth. So by diversifying our export base, over-reliance on copper makes kwacha vulnerable to global price shocks. So uh, we can promote value addition in agriculture, in tourism, in manufacturing, and non-traditional exports. So diversifying our export base will help um, reduce the currency risk. Secondly, we can also build and maintain adequate foreign exchange reserves. Okay, so foreign exchange reserves act as a buffer to stabilizing the currency during volatility. So how can this be done? You can use revenues from exports or donor inflows strategically to build on reserves. So reserves are important. Also, we can encourage the use of hedging instruments. So businesses exposed to such fluctuations can reduce risk by using financial tools like forward contracts, options, swaps through the Bank of Zambia. Also by improving fiscal discipline. Why? Because fiscal discipline and public debt are the ones that lead to kwacha depreciation. So how can this be done? You can rationalize government spending and enhance revenue collection and manage borrowing wisely. Number five, you need to adopt a transparent, credible monetary policy. Why? Because policy as credibility will help anchor inflation expectations and also stabilize the exchange rate. So you need to maintain this policy independence of the Bank of Zambia and communicate the decisions clearly. So this is how this can be done. Okay. So question number two.
Sorry, Mr. Collins, I think on the
Pardon?
significance, I missed some points there.
Okay.
On the significance, I missed some points.
Okay. On how what advice you can give to mitigate currency. So
Yes.
how we can mitigate currency fluctuations? The first one, you diversify your export base. If you're just exporting in copper, you export even in other, because copper fluctuates a lot. It's vulnerable to global prices. So you can encourage a country to venture into tourism, which brings in foreign exchange, manufacturing, and other exports. Secondly, you need to build and maintain what? Adequate foreign exchange reserves, because when we have foreign exchange reserves in a country like the dollar, it gives us power to avoid fluctuations in the currencies. So it is another very important tool. In fact, everything borders about us having a powerful reserve for exchange rates, okay, foreign reserves. They also encourage people to um, use financial instruments to guard against hedging, like futures contract, where you encourage people to agree or venture into contracts for a particular period of time that regardless of the fluctuations in currency, you are still going to trade at the unaffected prices. And also to improve the fiscal discipline where you're going to through the government rationalize on spending so to encourage revenue collection. And also adopt a transparent what and credible monetary policy. This is the job of the Bank of Zambia, the Federal Reserve, where this will help maintain credibility and maintain inflation expectations. Okay, so that is how you can advise government. So, Lab Green Libya acquired the state-owned Zamtel, a telecommunication company in Zambia months after change of government. The acquisition was abruptly cancelled without compensation. This situation epitomizes the risk involved in international investment. Using the case LabGrid and Zambia Zamtel, discuss four methods of growth of international portfolios of investment in international operations as opposed to the country of origin. So we remember very well that at the time we had what? We had Lab Green that bought our local network provider. So as part of international expansion, companies will have opportunities of growth beyond their borders or domestic limitations, but it comes with an inherent risk like political instability, okay, corruption, regulatory uncertainty, as was illustrated by what Lab Green in Zambia. That was in 2010 when they bought about 75% of Zambia. So here the state that came in because of back and forth, they reversed this in 2012 by a new government. So they cited some irregularities and no compensation was provided. So now this is one risk that international um, transactions face. Okay, so now we are here to explain, according to this question, four methods of growth in international portfolios of investment as opposed to country of origin. Okay, so what is the question asking for, in short? What is this question asking for, in short, in simple terms? So after getting the background, the question is asking that using Lab Green's a case as an example, we just need to explain four different ways that investors or companies can expand their investment into other countries outside their own. Okay, how can investors expand investment uh, beyond the borders of their own countries? So we're going to talk about any four ways. So number one, through foreign direct investment, like has been done here. So FDI is one of the ways in which you can invest outside the borders of your country. What is involved in FDI? FDI involves you getting to establish um, a company as an investor in a foreign business. So this could be you acquiring or controlling a stake of an existing company like LabGreen did. So the application is that LabGreen acquired Zamtel in the move as an FDI move, aiming to gain market share. The advantage is that you have control and access over the local market and the potential for high returns. The risk that political interference, as was seen where the buy unfortunately was cancelled. The disadvantage also is that regulatory changes and cultural differences in a foreign nation. How else can you expand beyond your borders? Through what we call joint ventures and alliances. Joint ventures and alliances. So when two or more companies from different countries form a partnership to pursue a shared business goal. For instance, the Libyan company like LabGrid entered into a joint venture with the Zambian government. That was what? A joint venture. So it reduces the perception that this company is being run by a foreign country. The advantage is that you're going to share the risk. You're going to embed yourself into local knowledge. It's easier for regulatory approval, and risks of disputes between partners are there. That's advantage, and there'll be an equal contribution, and there'll be different objectives. One will have this objective, the other one will have another objective. Okay. The other way in which you can invest beyond your borders is through what are called greenfield investment. So this is where a company will build its operations from scratch in a foreign country, including constructing new facilities and hiring staff. So in contrast with the LabGreen case, instead of acquiring Examtel, LabGreen could have built its new telecom. Like we are having this it's Z what? The new network, okay? The advantage that control of operations is totally yours. You have a tailored infrastructure, which you're going to do based on what you want. The disadvantage is a high initial cost, okay? It takes longer time to set up, and exposure to political and economic risks are there. How else can you venture into another nation's is through what is called portfolio investment. Portfolio investment just includes you buying bonds and stocks. You can buy those ones without um, shares in foreign companies without seeking control. So like Lab Green, they bought shares in Zamte, except that there were too many. So you would invest in a foreign nation. The advantages of liquidity and diversification, there's lower investment involvement. Its advantages are the market volatility, foreign exchange risk, and lack of influence on management. Okay, are we following? That was carrying
Yes, ma'am.
5 marks. Okay, we go to question number 3. Question number 3, we are told in the question, um, although balance of payment, although the BOP has to balance surpluses or deficits on individual elements may create some imbalances. There's also some concerns about deficits in the current account. Name the component of the balance of payment and discuss the importance of government and policymakers. Explain 3 reasons why BOP imbalances, and explain 3 possible processes that a country can use to correct the BOP imbalances. Okay, so what happens when you're talking about BOP? So BOP, what is BOP? You've heard of this term. What is BOP? So BOP basically, by definition, is a comprehensive financial statement that summarizes a country's economic transactions with the rest of the world. It's like a financial statement for a country. So it gives transactions in terms of exports, it gives transactions in terms of imports, cross-border investments, and financial transfers. So it is divided into 3 main components, as what we call the current account, the capital account, and the uh, financial account. So let's look at the 3 components of the balance of payments. Okay, 3 components of the balance of payments. What is involved in the current account? What is involved in the capital account? And what is involved in the financial account? So the current account includes all trades in goods and services, the incomes through dividends and interest, the current transfers that are remittances aid. So the importance is that it indicates whether the country is a net lender or borrower to the rest of the world. So a deficit shows the signal that we are over-dependent on imports. So we are weak at exporting. We have the capital account, which includes capital transfers and acquisitions or disposals of non-produced and non-financial assets like intellectual property, debt forgiveness. So it's important to track our non-commercial transfers. Okay, So we also have the financial account, which records um, investment inflows such as FDI, portfolio investment, reserve assets. So the importance of this account is that it reflects investor confidence and helps governments to monitor international capital movements. Okay, so these are the three accounts that we have. So we've talked about the three accounts that we have in terms of um, the financial of the country. So the current account, like I said, it shows the trade in terms of goods and services and income. The money that is sent or received in our country as remittances or foreign aid. This account is important because it shows if the country is earning more money from the world as a net lender, or the country is spending more money. Okay, so a deficit will mean the country imports too much. Then the current account, the capital account, this shows money transfers not linked to a regular trade like debt forgiveness, okay, or selling and buying of patents and copyrights. It's important because it gives track of unusual or one-time money movements, which are important for the government. And you also have the financial account, which reports investments from other countries, like these foreign businesses buying into local companies, stock market investments, and changes in foreign reserves is important because it shows how confident investors are in the country. Okay, so these are the key things we are looking at. Then part B, explain three reasons behind the imbalances that the bank BOP has. What are some of the three reasons why balance of payments may not balance up? Number one, trade deficits, where you have more imports and exports. Number two, excessive borrowing, where you, as a country, are borrowing too much, like we currently are. Number three, when there's a decline in what? There's a decline in FDI portfolios. So these are the three ways in which our balance of payment will not balance, will be an imbalance. So there are three ways that we talked about. Number one, trade deficits, when there are more imports and exports. So when a country buys more goods and services from other countries than it sells, to lead to a current account deficit. So Zambia, if they're importing more fuel, machinery, and consumer goods than we're exporting copper. So this creates an imbalance because more money is going out of the country and our exchange rate is affected. Then in the excessive borrowing, so when a country borrows a lot of money from abroad, they fund to fund the developmental projects, so to affect the country's financial account. So meaning government borrowing from international lenders. So the excess debt and interest payments. So when the BOP worsens, if not matched by the export growth. And there's a decline in foreign direct investment, FDI. So if foreign investors reduce investment due to political instability and poor economic policies, so it will lead to an imbalance. Okay, to lead to an imbalance. Okay, are we together? So we go to question number 4. Number 4. Okay, question number 4 reads, there is no guarantee that hire of astute managers will entail running the company for interests of shareholders. Even one of the most accomplished firms of auditors would save the collapse of the energy giant. Therefore, pancreas to agency problem lies in good corporate governance. This is evident by various reforms that were undertaken by countries such as UK, USA, and South Africa to address corporate failures. Reads the notes of CEO in preparation for presentation at a conference on building investor confidence. So to enhance his presentation, the CEO was asked you to briefly outline the key requirements of corporate governance reforms in USA, South Africa, UK that have instituted the following massive corporate failures, and explain similarities between USA corporate governance reforms and cyber securities, and identify the relevant remedies that CEO should recommend for multinational company that has recently established a greenfield investment in Zambia. So the first part we want to look at the key corporate governance reforms in USA. So this is current affairs in South Africa and UK, about 10 marks. Okay, so in USA, we can look at the following reforms. Number one, they established a strict auditing standard. So these were responsible for accuracy in financial statements. So there was a requirement for stronger internal controls over financial reporting. So whistleblower protections were there to encourage the reporting of corporate fraud. Secondly, in UK, there was which was formerly the combined court. So the comply or complain principle. The companies were asked to follow this code and explain why they don't. So this also helped in separation of roles, where the chairman and CEO should not be the same person. The independence of the board was advocated for, where at least half of the board should be independent and non-executive directors. And last but not least, the board committees were required to audit remuneration and nomination. Then in South Africa, according to the King's report, King the third and the fifth and the fourth emphasize on ethical leadership, sustainability, and integrated reporting. So explain and apply principle of King the Fourth encourages practical application and not just compliance. It focused on stakeholder inclusiveness and not just shareholder value. So it promotes transparency, risk management, and performance evaluation. So these are some of the reforms from these world bodies with current affairs. Right. Part B and C asked to explain the following. B and C were asked to explain the similarities between USA corporate reforms and Zambian Securities Act of 2016. What are the similarities? So the similarities are as follows. Number one, in terms of direct accountability. Number two, in terms of disclosure of transparency. Number three, in terms of audit oversight. Okay, these are some of the similarities that we have, and investor protection measures have both created regulatory bodies like SEC as USA and SEC Zambia, and penalties for fraud and insider trading have been instituted in both countries, where there are stricter penalties for insider trading when somebody is giving or leaking information to obtain financial gain. So these are similarities within the two countries. So in here,